Welcome back to The Explainer. So, if you follow business at all, you already know that accounting, well, it's not just about crunching numbers. It is literally the fundamental universal language of global commerce. It's this incredibly sophisticated architectural framework holding the entire global economy together. Today, we're popping the hood to decode the precise grammar of that language, GAAP. To really appreciate what this means, I want you to imagine playing a high-stakes game where every single player gets to just make up their own rules for keeping score. I mean, it'd be sheer chaos, right? Well, that is exactly what the business world would look like without a standardized rulebook. Imagine the absolute nightmare for investors, banks, and tax authorities if every single company simply decided for themselves how to report their financial health. You'd literally never know if a company was truly profitable or just, incredibly creative with their math. Okay, let's dive into this. Here's our roadmap for today's explainer. We're going to start with the rules of the game, then explore time and the business, unpack the prudence principle, look at consistency and transparency, and finally, we'll wrap the whole thing up with the materiality exception. All right, Section 1, the rules of the game. So the acronym you are going to hear absolutely everywhere in the financial world is GAAP. That stands for Generally Accepted Accounting Principles. Now, these aren't just minor suggestions. These are the fundamental ideas, the basic assumptions, and the broad working rules that form the entire foundation for the theory and practice of financial accounting. Anytime a business transaction is identified, measured, recorded, summarized, or reported, GAAP is the ultimate guide, dictating exactly how it should be done. At the end of the day, the absolutely crucial point here is trust. Why does GAAP matter so much? Because it creates a level playing field. By providing a highly standardized framework, these principles bring much-needed uniformity to accounting practices. They ensure consistency not just within one business, but across all businesses. This is what makes financial information reliable. If you're an investor looking at two completely different companies in entirely different industries, GAAP allows you to reliably compare them side by side because you know for a fact they're playing by the exact same set of rules. Moving right along, Section 2, Time and the Business. There's actually a really fascinating tension in accounting between two core concepts. On one hand, we have the going concern concept. This is the basic assumption that a business is going to continue its operations indefinitely, or at least for the foreseeable future, without any intention of closing down. But practically speaking, we obviously can't wait until the end of time to see if a business made a profit. So we balance that with the accounting period concept. Because the business has an indefinite life, we have to artificially chop that infinite life into specific, shorter intervals. Usually, that's a conventional 12-month accounting year. And this brilliantly illustrates why that division is just so critical. By chopping that infinite going concern life into these 12-month accounting periods, we create a really reliable rhythm. Think about it. Owners can make periodic assessments in year 1. Tax authorities get their reporting in year 2. Investors get their updates in year 3. It allows literally everyone to measure the ongoing performance and financial position of the enterprise without having to wait until the business actually liquidates to see how they did. Let's connect this right back to the real world. That going concern assumption, the idea that the business will live on indefinitely, is the exact reason why we handle big purchases the way we do. Imagine a company buys a massive, super expensive factory machine. Because we assume the business is going to be around for a long time, we don't just take that massive expense and totally destroy the profit and loss account in year 1. Instead, we spread the cost of that fixed asset out over its useful life through a process called depreciation. It's honestly a perfect example of these theoretical rules solving incredibly practical problems. Next up, Section 3, the prudence principle. If you've ever felt like accountants are, well, a slightly pessimistic bunch, it's actually baked right into their professional DNA. It's called the conservatism concept or the prudence concept. It operates on this legendary, traditional rule: anticipate no profits, but anticipate all losses. Read that again. It's naturally cautious. The whole framework is designed to protect the business and its investors from overly rosy projections. Accountants are trained to be inherently conservative, just to make absolutely sure a business never looks better on paper than it truly is in reality. Now, what's really interesting about this is it creates a strict double standard in the rulebook. Under the prudence principle, how do we treat profits? We account for them only when they're actually realized, when the ink is dry and the money is basically sitting in the bank. But how do we treat losses? Well, if there is even a remote possibility of a loss on the horizon, GAAP dictates that we account for it immediately. It is a built-in safety net of extreme skepticism. All right, Section 4, consistency and transparency. So, how do businesses build long-term trust and ensure honesty year after year? They do it through the consistency concept. This rule clearly states that the accounting methods and procedures adopted by a business absolutely must remain the exact same from year to year. You pick a method in year 1, you stick with it in year 2, and you keep it rolling in year 3. You cannot just jump around and change how you calculate things simply because a different method might make your numbers look a little better this quarter. The logic here is incredibly powerful. By forcing companies to apply their accounting policies consistently, you completely eliminate personal bias from the reporting. If management can't change the rules of the game every single year, well, then the numbers tell the real story. It allows you to actually track your progress meaningfully across different time periods. And critically, it enables accurate benchmarking against other competing enterprises in your sector. Paired right alongside consistency is the full disclosure concept. This principle basically mandates that there are no hidden tricks. Financial statements, and yep, all those tiny footnotes at the bottom, must completely, fairly, and adequately disclose all relevant information. This guarantee is vital. It means that any user of those statements, whether it's an investor, a bank, or even an employee, has all the necessary facts laid out bare to accurately judge the true profitability and financial soundness of the enterprise. Let's move to our final section and see how this builds. Section 5, the materiality exception. Closely related to the idea of full disclosure is the materiality concept. This clarifies that while the rules are incredibly strict, a business really only needs to focus on relevant and material information. So what does material actually mean here? It's defined as any information that would reasonably influence the decision-making of the people reading the reports. Basically, GAAP isn't about sweating the incredibly tiny, trivial details that ultimately just don't matter to the big picture. I love this example because it's just so relatable. Strict adherence to accounting principles is not required for things of little significance. So, treating massive machinery as a fixed asset and spreading the cost over years? Absolutely necessary. But meticulously tracking the useful life of a box of pencils or an eraser? No way. For trivial items like pencils, you just expense the cost immediately. It simply wouldn't influence an investor's decision if you capitalized a $2 eraser. So, as we look at the big picture of GAAP, the uniformity, the careful slicing of time, the built-in prudence, the unwavering consistency, and the practical materiality, I really want to leave you with this thought. Without these rules, could you ever truly trust a company's success? GAAP is so much more than just math. It is the ultimate bedrock of trust in the global business world. Thanks for joining me on this explainer, and I hope you leave today with a profound appreciation for the true language of business.